Welcome to Law Easy. My name is Marty Schenkman, and I'm joined for this video planning clip with Joe Bodan, who's a partner in PKF O'Connor Davies in their Harrison, New York office. Thanks for joining me, Joe.
You're welcome,
So the
Marty.
topic is a very practical one on closely held business owners. We're going to talk about some of the current operational or short-term goals and the impact on type of entity. So you said when we were chatting beforehand that before you really can get to the tax and legal planning, you have to have a discussion with the business owner, what they're trying to do, what the type of business is. Maybe you could
Exactly.
elaborate a little on that.
Yeah, we like to have a discussion and talk with the business owner and break it up into, what are the things that you currently worry about? A real like SWOT analysis, what keeps you up at night? Those are the current day-to-day things. Then we try to talk to them about where do you want your business to go in the next 3 to 5 years, go out a little further, and then ultimately we get to an exit strategy.
Which we're going to cover in another video clip.
Which
So
we will.
we're staying short-term, folks, on this one.
Okay. So once we get all of that information, then it gives me the ability to advise correctly on the choice of entity for tax and is it the right entity for your operations and as you continue to grow, as well as the exit strategy. So we need that information first.
One of the things that we're talking about, and I think it'd be helpful to elaborate on, is the different tax rates. So the 2017 Tax Act reduced the rate on corporations to, I think, 21%.
Flat 21, yep.
How does that compare to individual rates and the 199A deduction?
Sure.
Maybe explain all that, because there's some complexity to that.
Yes, the top individual rate used to be 39.6, and the 2017 Act reduced it to 37. So the top individual rate's 37%. The 199 deduction that you mentioned is a brand-new provision of that law, and it allows business owners that have flow-through entities, partnerships, S corporations, or even sole proprietorships, to get a 20% deduction on the net business income.
QBI, Qualified Business Income.
Qualified business income. So if you take, basically 80% of 37%, the top individual rate, if you're getting the QBI deduction, is 29.6%. So we're looking at a top individual rate of 37%, an individual rate with a QBI deduction of 29.6, or a C corporation with a flat 21%. And I've gotten a lot of calls from current clients that are not C corporations. They hear 21% rate and they say, shouldn't I be a C corporation?
That's usually because they're playing golf with someone.
Yes,
paying a lower
cocktail
rate.
party or
Right,
something like
right.
that, yeah.
Right. So you got to be mindful of which rates apply, and the QBI deduction, 199A, is another whole complex topic we're not going to get into. But don't assume you're going to qualify without confirming, because lots of requirements for that too. One of the things you said that was interesting is certain industries have a tendency to use certain types of structures.
Yes.
You mentioned, for example, real estate. Maybe
Yeah.
you could elaborate, give some examples.
Yes, I mean, real estate is the real obvious example here. Real estate is the only industry where there are tax rules that allow you to use non-recourse debt in basis to claim losses
Right.
and to claim tax-free distributions. No other industry has that. So if, I would go as far as saying if somebody was starting a real estate business and they were using, regular finance debt from an unrelated party, having it in a C corporation would almost be malpractice. You'd want to have it in a partnership or an LLC taxed as a partnership.
Yeah, I've seen other structures, and they are problematic. You mentioned also that if you have charities or foreign investors, certain types of structures may make more sense. Maybe
Yeah.
you could elaborate on that.
Well, for instance, an S corporation, there are limitations as to the type of shareholders that are eligible to be an S corporation. So, foreign entities, certain charities, certain trusts. So if that is going to be the people that are owning your company, an S corporation is out.
Right. And just for viewers, we have other video clips on the site talking about QISTs and SBITs and the other requirements of grantor trusts owning S corp stock, but we're not going to get into that. We just want to kind of paint the bigger picture. If I'm setting up an entity, a business, and I need to pick an entity, and I'm going to reinvest any money the entity makes for the foreseeable future to grow the business. Does that suggest a certain type of approach?
It does, and I've run the numbers on this, and comparing, because I have a lot of clients that are flow-through entities that do qualify for the qubit deduction, and they're at 29.6, and I've proved to them that if you have a business that is reinvesting and you're not distributing the profits annually to the owners, that the most tax-efficient structure for those years would be a C corporation, because you're avoiding a double taxation. So even though you're paying a 21% rate and you're not distributing it out as a dividend being taxed again. Whereas if you're in an S corporation or a partnership, whether or not you distribute it out,
You're paying tax.
You're paying tax on
Right.
it.
So it's certainly worth doing some kind of forecast to see what's going to pan out for somebody.
Absolutely.
So what if in contrast to my growing a business and reinvesting everything, I'm really looking at pulling out most of the income because I need it to live on? What does that suggest for the type of entity you may want to choose?
Well, then you would want to have I think, a partnership. You could have an S corporation, but then if you have distributions that are not salary, the IRS could reclass some of those distributions as salary. They're basically saying your salary is too low. But with a partnership or an LLC taxed as a partnership, it doesn't matter. So if you're bringing out every dollar, you're being taxed on it anyway.
Right.
So the distributions are taxed. There isn't a double level of tax.
Any concluding comments just to sort of wrap up? Because then I have one last question after you conclude that I didn't prepare you for.
Oh, okay. No, so it's a matter of, and I would say that even though we talked about a C corporation being the most efficient, if you're going to reinvest, we do have to talk about the exit strategy later, because that
We
could
will.
change the
Another video
answer.
clip.
That could change the answer.
So the unfair question I didn't talk to you about before, and I don't feel too bad asking because there's really no answer, but the Democratic candidates, because we're now at the end of 2019 and the election is forthcoming and next year, who knows, not even trying to predict who may win or not, but the Democratic proposals may well see a raise in individual rates. They may see a significant raise in corporate rates. They may eliminate the 199A deduction. How do you even try to factor that in? I mean, you have no idea what to do.
No, it's very difficult, and, if you talk to any business owner, they want certainty. And when they
not
don't
with our
have
tax
certainty, how
laws.
could you
Right.
plan with that?
So whatever you do may all have to be revisited anyhow because you really can't predict what's coming.
I have current clients where they're looking to, let's say, do a change away from LIFO, and they would pick up income over 4 years.
LIFO's last in, first out inventory?
Inventory.
For the
Okay.
folks that don't know that acronym.
Okay. And, there's concern about, well, if we have to spread this out over 4 years, what if the rates increase and
And
they've
who
stopped
knows?
doing it?
Right.
So they're holding off, maybe waiting for the next election to see what happens.
So I want to thank Joe Bodan for joining me. Thank you for listening. Please remember that all the video clips are for educational purposes only. Do not take any action whatsoever without consulting with appropriate advisors and doing your own research. Thank you.